Today, we will talk about a beginner's guide to investing in stocks. Investing in stocks means buying shares of ownership in a public company. Those small shares are known as the company's stock, and by investing in that stock, you're hoping the company grows and performs well over time. When that happens, your shares may become more valuable, and other investors may be willing to buy them from you for more than you paid for them. That means you could earn a profit if you decide to sell them. A good rule of thumb is to have a diversified investment portfolio and to stay invested, even when the market has ups and downs. One of the best ways for beginners to learn how to invest in stocks is to put money in an online investment account, which can then be used to invest in shares of stock or stock mutual funds. With many brokerage accounts, you can start investing for the price of a single share. Some brokers also offer paper trading, which lets you learn how to buy and sell with stock market simulators before you invest any real money. How to invest in stocks in 4 steps. There is no one-size-fits-all method for how to invest in stocks, but this 6-step process could help you get started. First, figure out how hands-on you want to be. Open an account. Choose between stocks and funds. Set a budget. Focus on the long term. And finally, manage your portfolio. 1. Decide how you want to invest in the stock market. There are several ways to approach stock investing. Choose the option below that best represents how you want to invest and how hands-on you like to be in picking and choosing the stocks you invest in. I like to choose stocks and stock funds on my own. Keep reading. This article breaks down things hands-on investors need to know, including how to choose the right account for your needs and how to compare stock investments. 2. Choose an investing account. Once you have a preference in mind, you're ready to shop for an investment account. For the hands-on types, this usually means a brokerage account. For those who would like a little help, opening an account is a sensible option. We break down both processes below. An important point, both brokers allow you to open an account with very little money. The DIY option, opening a brokerage account. An online brokerage account likely offers your quickest and least expensive path to buying stocks, funds, and a variety of other investments. With a broker, you can open an individual retirement account, also known as an IRA, or you can open a taxable brokerage account if you're already saving adequately for retirement in an Employer 401 or another plan. It offers the benefits of stock investing but doesn't require its owner to do the legwork required to pick individual investments. Robo-advisor services provide complete investment management. These companies will ask you about your investing goals during the onboarding process and then build you a portfolio designed to achieve those aims. This may sound expensive, but the management fees here are generally a fraction of the cost of what a human investment manager would charge. Most charge about 0.25% of your account balance. And yes, you can also get an IRA if you wish. One thing to note is that although are relatively inexpensive, read the fine print and choose your provider carefully. Some providers require a certain percentage of an account to be held in cash. The providers generally pay very low interest on the cash position, which can be a major drag on performance and may create an allocation that is not ideal for the investor. These required cash allocation positions are sometimes more than 10%. If you choose to open an account, you probably needn't read further in this article. The rest is just for those DIY types. 3. Learn the difference between investing in stocks and funds. Going a DIY route? Don't worry. Stock investing doesn't have to be complicated. For most people, stock market investing means choosing among these 2 investment types: stock mutual funds or exchange-traded funds. Mutual funds let you purchase small pieces of many different stocks in a single transaction. Index funds and ETFs are a kind of mutual fund that tracks an index. For example, a Standard & Poor's 500 fund replicates that index by buying the stock of the companies in it. When you invest in a fund, you also own small pieces of each of those companies. You can put several funds together to build a diversified portfolio. Note that stock mutual funds are also sometimes called equity mutual funds. Individual stocks. If you're after a specific company, you can buy a single share or a few shares as a way to dip your toe into the stock trading waters, building a diversified portfolio. out of many individual stocks is possible, but it takes significant investment and research. If you go this route, remember that individual stocks will have ups and downs. If you research a company and choose to invest in it, think about why you picked that company in the first place if jitters start to set in on a down day. The upside of stock mutual funds is that they are inherently diversified, which lessens your risk. For the vast majority of investors, particularly those who are investing their retirement savings, a portfolio made up of most mutual funds is a clear choice. But mutual funds are unlikely to rise in a meteoric fashion as some individual stocks might. The upside of individual stocks is that a wise pick can pay off handsomely, but the odds that any individual stock will make you rich are exceedingly slim. I'd like an expert to manage the process for me. You may be a good candidate for a service that offers low-cost investment management. Virtually all of the major brokerage firms and many independent advisors offer these services, which invest your money for you based on your specific goals. I'd like to start investing in my employer's 401k. This is one of the most common ways for beginners to start investing. In many ways, it teaches new investors some of the most proven investing methods, making small contributions on a regular basis, focusing on the long term, and taking a hands-off approach. Most 401ks offer a limited selection of stock mutual funds, but not access to individual stocks. 4. Set a budget for your stock market investment. New investors often have two questions in this step of the process. How much money do I need to start investing in stocks? The amount of money you need to buy an individual stock depends on how expensive the shares are. Share prices can range from just a few dollars to a few $1,000s. If you want mutual funds and have a small budget, an exchange-traded fund, ETF, may be your best bet. Mutual funds often have minimums of $1,000 or more, but ETFs trade like a stock, which means you purchase them for a share price, in some cases, less than $100. How much money should I invest in stocks? If you're investing through funds, how we mentioned this is the preference of most financial advisors. You can allocate a fairly large portion of your portfolio towards stock funds, especially if you have a long time horizon. A 30-year-old investing for retirement might have 80% of their portfolio in stock funds. The rest would be in bond funds. Individual stocks are another story. A general rule of thumb is to keep these to a small portion of your investment portfolio. What do you think about our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.